What is up, everybody? It's Matt Druin here with Misfits of Real Estate, flying solo this week. I feel so bad for Mark, who's probably in I don't know, Jack, did Mark say where he was?
I think he's in the Bahamas, he said. So he's somewhere
Oh,
nice.
Bahamas, the son of a bee. All right, I'm here up in and I mean Jack's not looking too shabby either. Being in sunny Puerto Rico, so. Anyways, Jack is a old friend of mine and also a friend of Mark Updegraff's as well. So we wanted to bring him on today on this solo edition. So I'm going to see how I can perform being a solo pilot on this show here. But a little bit about Jack. I'm just kind of going to do this organically because I'm not just going to go through some verbose bio or anything like that. But I've known Jack basically has worked across all of the spectrums of the real estate industry. Known from Rochester, former RIT grad. Shout out to all the RIT graduates out there. And started in the trenches of real estate, from doing the wholesaling, fix and flipping, foreclosure, sheriff's auction properties, that sort of thing. And then, has had all this experience in terms of working on Wall Street, working with private equity companies, family offices, and to where he is right now, where he's raising capital with JCAM, alternative investments, and partnering with sponsors across the country. So, Jack, I just wanted to thank you for coming on the Misfits of Real Estate.
Yeah, thanks for having me. We've known each other a long time. I think you actually, you and your dad sold my wife a condo in Rochester, her first condo purchase way back in the day. So, and you've been following your career as well, and you've done great. And I'm really excited to collaborate with you guys.
Yeah, absolutely. Full disclosure, I had Jack on my show, Go Big Live, last week. So I definitely, Mark and I take a different spin on this show. I do want, for people that have never even heard of you before, kind of give us some brief background on your background and also your focus now and what you do.
Yeah, absolutely. So, I'm from New Jersey, but I went up to Rochester to attend RIT and was there during the dot-com boom, and thought I was going to be in information technology, thought I might go work for Cisco or IBM or and then Google was really just getting started. I'm dating myself here, but I graduated in 2001, which was during the dot-com crisis. Mm-hmm. And there wasn't as much job opportunity as I thought, but I had a good starting salary and good credit, so I started buying houses, no money down. I actually read a book at the airport, how to do no money down real estate. And my college landlord, who became a mentor of mine, helped me find my first few deals. And then within a year, I quit my job, started flipping houses, doing some property management, wholesaling, going to the sheriff's auction, going to the tax auction. And, really just kind of dove in head first, certainly made some mistakes, but learned a ton and had some successes as well. When everything froze in 2008, there was a lot of private equity and hedge funds buying mortgages, and they needed real estate people because these were a bunch of bankers who didn't really know what to do, and they didn't want to get eaten alive by the local sharks that buy at the sheriff's auction. So I was able to come in-house at a private equity fund to help them manage their portfolio of distressed loans, non-performing and foreclosed REOs. So I was in that industry for 10 years, eventually went on my own, raised some money from a family office, and then partnered with a multi-billion-dollar private equity fund, and we bought billions of dollars of loans together. So it was a really exciting time. I met a character from The Big Short who was one of the groups buying our bonds, but it wasn't the lifestyle I wanted. It was I got into real estate for that passive income and for that both financial freedom but also freedom of time. And unfortunately, it got too Wall Streety after a while. So I'd been investing passively in some syndications, and once I left my firm and eventually got bought out, really built a business around investing more passively into larger real estate syndications, which I think for many investors, especially the higher net worth and the accredited investors, is potentially a much better way to invest than just investing in single family real estate. With size and scale comes some benefits, including tax benefits. So it's been a great pivot for me in my life. I love helping people. I love educating on the syndication space, and it's been a great ride.
So something that was surprising to me, Jack, was that I thought that to become a syndicator, that you had to raise the capital, and find the opportunity as well. And you told me that that's not necessarily true. So tell us about that.
Yeah, it's something that I, certainly learned over time as well. And it came from one of my mentors, who's also someone I was investing passively with as well. So it's really tough to find good opportunities, and whether it's small or large scale. So most operators, and I'll use the term syndicator and operator interchangeably, but they're the ones that are the boots on the ground, and they'll often look at 200 to 300 deals to find one good deal to invest in. And so once they find that deal, they've got 45 or 60 days often to raise millions of dollars, because these, I'm talking about larger deals. Sometimes it's a $30 million acquisition where you need to raise $10 million in 30 to 60 days. Even the best operators, they have their friends and family money, et cetera, but to raise 10 million in a short period of time, it's extremely nerve wracking, and you have a hard deposit down most of the time, where if you don't raise all that money, you might lose $1 million of a hard deposit. So because of that, they look for partners that are in the capital raising business or have their own funds as well that can raise larger checks. So they may raise five on a $10 million deal. An operator may have 5 million from their friends and family, but that other five, either they're dialing for dollars, talking to strangers, trying to raise $50,000 from another 50 to 100 people, or they go to somebody like me who's already invested with them and has basically built a business around not chasing the 200 deals to find the one good one, but I've got 5 to 10 groups that look at those 200 deals and each send me one deal a year. So I might do 10 deals out of 2,400 deals that operators are looking at. And because we can raise larger amounts of money, and because we're consistently investing and partnering with them, we get special terms. So often there's no additional fees for us being involved. We're actually a partner in the deal. And by being a partner in a deal, we're essentially bringing our investors in alongside the operating partners or sponsors that are the ones that found the deal, and they're the ones that are generally going to do the day-to-day operations going forward. I often get what I'd call like a board seat, or I'm on the committee. I'll definitely sit in on calls, and I'm more aware of what's happening than, say, my passive investors, although we do great reporting. But yeah, that's the gist of it. Is there's room for people to just raise capital.
Yeah, excellent. Yeah, that was something that was completely foreign concept to me. And actually, I'd love to be in that space eventually as well, because I'm on the distribution list for a lot of different operators. And myself being an active operator, the one that needs to find the opportunities. I mean, yeah, you hit the nail on the head. Like, I look at hundreds of properties, make tons of offers, and we usually land one deal a year. And so, it's a lot of freaking work that goes into that. So it's almost like you bring that essential piece to the component. And the capital raising is, outside friends and family is one thing. When you tap outside of friends and family, it becomes a lot more difficult to raise capital, because now you're dealing with more people that are used to investing in syndications, they're used to investing in funds, and they get presented a lot of opportunities. And now even capital raising has become much more harder now that the music has sort of stopped playing with the multifamily space. So now people like you and people like I aspire to be eventually in terms of the capital raising space add a tremendous amount of value to the equation for operators out there that are looking for investment capital.
Yeah, absolutely. And you hit the nail on the head where it's not easy, but also what I'd like to add is, a great majority of my initial investors had never invested in a syndication before. So there's a lot of education that needs to go along. And I was in New York, and even a lot of our vendors and people I did business with that weren't in New York that, had 7-figure businesses, multimillionaires that had almost all their money just in stocks and bonds. Maybe they owned a vacation home or one property themselves, but the entire syndication industry of how a deal is structured, how there's a preferred return, how there's a profit split, it's foreign to many investors, even those that are multimillionaires. So, it takes someone that they have the personal relationship, that they have that they know, they like, and they trust, that they can, understand that, this is how things are structured, that it's not too good to be true. And I've had a lot of conversations about that of like, well, a REIT pays an 8% dividend. How are you paying an 8% preferred return and giving 70% of the profits so that a return could be 15 to 20%? and just having to walk them through just why it makes sense, why a private deal that doesn't have the exposure of being able to go on E-Trade and click a button to buy is going to offer a higher return, how it's more like owning or investing in a business that has a profit margin than it is investing in a stock where it's, a very efficient market and most of the data is priced in and it's going to trade more like the S&P. So, this is a relatively new industry. There's been private placements for 50 years, but it's really been since 2012 when the government changed the rules for the Regulation D private placements, where advertising has been allowed. Before that, you had to, they were called country club deals. You literally had to know someone, and it was pretty much illegal to advertise, and you could only talk to people with pre-existing relationships. So it was really tough to find these deals until 10 years ago.
My next question is on the side of, you talk to operators, you meet with operators that you partner with. What is your step-by-step vetting process for when you're deciding to build a relationship with a operator and actually do a business with them?
Sure, and that's it's definitely evolved over time. Some of the initial deals were probably a lot more of the way that some of my investors are with me. It's like, okay, I knew someone already, or a friend referred in, and it was, we did look at the deal, talk to the sponsors, a little more gut and feel. Now, there's a whole checklist of items both on the sponsor side and the property side. Just what is their experience, what is their track record. Certainly, like sponsors that have been through a crash and have a couple of gray hairs that have been through a cycle, but that's not a hard requirement. Because it's also some of the younger hustlers are the ones that find the really good deals as well, because they're the ones that are aggressive and knocking on the doors. So, first things first is a sponsor. Just making sure, ethically and core values, and are we comfortable working and do business with them? Do we have mutual contacts? It's very rare we're working with anybody just off the street. I'm in a number of mastermind groups, so anyone that we don't already invest with is usually coming from a trusted source, a mastermind group, or a very close contact or investor. Then it comes down to the property side, and there's a ton of dynamics, obviously, and every deal is different. But one of the core asset classes I'll just focus on, because it's probably half or more of our business, is the value add component, and it's typically a nice building but old and dated. For example, something built in the 80s that still has some original kitchens and bathrooms in it, where the rents are maybe $1,200, but with a new kitchen, new bathroom, new flooring, you get $1,500 or $1,600. And we really hone in on, is that plan, do we believe in that plan? Do we trust the comparables? What is the purchase price of the building? Is it in line with comparables? If the rents, it's basically just running through the numbers. And the one thing you can control is that budget. Now, if the economy crashes and everyone's out of work, maybe it's different, but you can't really control interest rates. You can make some projections. You can't really control where cap rates are in 5 years, but if you nail that value add component, that's the top thing we look for when looking at whether to make a decision to invest or not, is do we believe they're going to be able to raise those rents? Because at least if they execute on that part of it, that's probably 70% of success of the model. And then some of it is just, where timing and where cap rates are. There's some deals that people made crazy returns in 2021 when interest rates went to zero. And we personally doubled our money on a deal in 12 months and 2 days. The pro forma was an 18% return in average, like an IRR over 3 years, and we doubled our money in 1 year. So crazy things can happen, but we would have made money on that deal regardless, just because the rents increased by so much. It just happened we sold in a year. So those are the two main components. And then it's we do look at, how is their reporting? Are they reporting on time on other properties? Do they get their tax documents out? Most people, unfortunately, we have to file extensions in this business because it's rare that all the K1s come in before April 15th. But we did have a sponsor who's on our naughty list right now, because their K1 was very late. It didn't come out till close to end of summer, and that's been a one-time issue. But K1s are very important, and especially for new investors. If you've never had a K1, it's similar to a 1099 but different. It's just a separate tax form that you get and you provide to your accountant, and usually it's going to show a negative number which is in this case good because it's actually showing that number on paper from depreciation, which allows you to defer some of your tax income. If you have other rental properties, it can offset. It's a very powerful thing for those that can take advantage of it. And it's one of the key reasons I invest in this industry.
So you mentioned the K1 thing there. Now there's a daisy chain thing that can happen here in terms of this whole industry. So traditionally, for those of you who don't have partnership returns, your tax return isn't due on the 15th of April, it's due on the 15th of March. So putting yourself in the standpoint of Jack's position is that he's partners in a partnership so that their return is going to be like it's going to be due by 15th, but I almost have to get it in before the 15th because you guys have to do your thing as well with that. So tell me about that.
Sure. So yeah, we're definitely, we notified all of our investors a month ago, and pretty much any new investor that's coming in is like, you're going to file an extension. Mm-hmm. Now we've got probably 75% of our K1s in already, but there's a few that we know are not going to show up before April 15th. Yeah. And, it's complex. There's a few groups that have multiple properties in them, and then, you need to finalize the return for each property before you can then finalize the return for the fund. And then we need, 2 weeks to turn around our K1. So, I've frankly filed an extension probably every year since 2002 or 3 for myself. So, it's not really an issue for me, but for those that are coming in that have been mostly W-2 and don't have a lot of alternative investments, it might be a new thing. But that same issue comes up in September. Certain people who have trusts, their deadline is September 15th, not October 15th. The deadline for individual is October 15th. So, yeah, it's a constant battle, and it's just something that, when you're investing in these private deals, that is just kind of part of doing business. Best case scenario, though, you're getting a bigger refund, or you're actually saving money on your other property. So it's worth the wait because you're saving money anyway, and you'll get, either a bigger refund than you would have, or have to pay less if you're in that spot where you have a lot of other passive income.
Yeah, I'm trying to think of ways that mechanisms, and I don't know, maybe you have them, or maybe it's just like it's just like, hey, this is what is supposed to happen, and I trust you to make that happen. But what makes me think is like, because with me, thank God I have my partner David Martin, because he handles all the operations of the company, and he gets all their tax returns and partnership tax returns like way ahead of time, like clockwork. Is preparing for it at the end of the year. Me personally, I'm a mess. Like I file an extension, and I'm like filing on October 15th, like every year. Right. So I'm wondering like if there's a mechanism with sponsors where you could be like, okay, if you miss your deadline in terms of when you get it in by this date, then you get penalized for doing that. Because
we're constantly thinking of that. I will just give it a quick antidote. I was on a Zoom last week with one of the masterminds I'm in, where we have probably 30 investors, and a group presented a new deal. And separate from this group, I'd previously invested with this group, and they're doing great performance wise, but their K1 was pretty late last year. And I called them out in front of 30 people that, hey, you guys are doing great. I could vouch for you operationally, but I've got a bone to pick with you. And that K1 was very late. Like, can you commit to getting your K1s on time for this next deal? So even without a financial penalty, just when you have future investment dollars, there's no bigger incentive than future investment dollars in a long-term relationship to build.
Yeah, no, 100%. Yeah. And I hate to belabor the subject matter, but I remember one time this was the first time I was doing a partnership term with a high net worth individual that we did a joint venture with. By the way, full disclosure, for anybody listening to this or watching it, I've never done a syndication before as an actual sponsor, like a sponsor or anything like that. I've invested passively in deals before, but every deal that I've done as like a lead person has always been a joint venture. And this, it was like getting down to the wire, and this partner called me up, and he was a major investor of mine. He was like, if I have to file for an extension, then I'm not going to invest with you anymore. And I was like, oh crap, I cannot let this happen ever again. And thus, long story short, we have Mr. David Martin on board with Oak Grove Development to make sure that doesn't happen. So moving forward a little bit, I guess what are some major red flags with that you spot with potential sponsors that you meet that other people could be aware of?
Yeah, so especially given the last year or two, it's like, do they have problems with any of their current deals? That's certainly, even if the new deal is an amazing deal, like we do look at, are they going to have legacy issues?
Mm-hmm.
Because maybe their current infrastructure is supported by some other properties, but if they're losing money on other properties, it may affect their performance. We certainly look at the underwriting, and just somebody who's way too optimistic with underwriting, just showing, banking on just rent growth, cap rate compression, or just selling at aggressive numbers. I mean, the deal, you need to underwrite conservatively right now, especially after what we've seen with the crazy moves in interest rates, the increases in insurance costs, increases in property taxes in some markets. Just seeing somebody who, it just raises red flags that maybe they lack experience, or they're just being too optimistic and just doing whatever they can to try to get the deal closed. And just a lack of references. I mean, anybody who's I think a quality operator sponsor is going to have a number of investors who are willing to sing their praises and give a positive recommendation.
Mm-hmm.
So those are the key ones.
So on the optimism in regard to pro forma underwriting, I mean, one of the things is that when I underwrite deals so conservatively that my projections look like crap. So, and I've always made a point of that, and in terms of like, if I'm looking at projections on a property that make me excited, then I should be actually concerned. What do you say to that?
I think the best case scenario, and our most sophisticated partners, sponsors, operators, just build out a sensitivity analysis. Then you can look at all scenarios, and you can kind of figure out where you're most comfortable. You could look at an exit. There are deals where it's like, if the 10-year drops to 3% in the next 24 months, it's not out of the question you exit at a 4.75 cap. That could easily be in a table. If we sell at this cap rate and we've gotten this rent growth, this is the number. If we only get to this cap rate, and then you have all the possible scenarios, and you never know which one is right. But you can look at you've got a good margin for error, and you know what your worst case and your best case scenario is, and then you can make an educated decision. So I'm not that Excel guy. I'm not the one who could build that, but fortunately in commercial real estate, there's a ton of just very experienced, analysts and quants that can generate, all the scenarios in Excel. Now, granted, you need your own to just make sure that the numbers all tie out. But ultimately, when you get to those tables, it's coming from a couple data points. What's the net operating income? What's the cap rate? And where interest rates at the time. So it ends up not that complicated. It's just end of the day, it's simple math, but it's amazing the things you could do with Excel these days.
That's actually a great point. I mean, it's something I'm actually going to take into consideration, because when I put together my pro formas, I've actually had investors being like, Matt, like, this doesn't look like a good deal. Like, why are you even excited about it? And because I present it in one way, right? My super conservative way. And I know in the back of my mind is like, I'm going to blow these numbers out of the water. I just know it, but I don't want to make that promise to people that are going to be partners with us with the expectation of letting them down. So I'll definitely have to use that in the future in terms of the sensitivity analysis. So then I can leave it on them. It's like, this is the way, conservatively that I'm thinking in terms of like, not doomsday scenario in terms of like fire and brimstone falling out of the sky, but from the scenario of like, the most likely worst case scenario, and then including a sensitivity analysis so that they can kind of come to their own conclusions. Because there might be investors that are like more optimistic than you are about deals, and kind of leaving that decision to them in terms of what type of inclination that they want to have towards a deal. I think is pretty smart. So let's move on to what you're doing currently. Are you currently raising for a fund or any opportunities as of right now, or what?
Yeah, so we actually have two different funds. We run three funds total, one of which we've closed to new investors, and it's essentially at its wind down period. As properties sell, we're returning cash, and most of
Mhm.
those investors are then reinvesting into one of our future funds. So
Mhm.
we have two funds that are open right now. One is our diversified fund, and that fund we raise for about 2 years, and as we raise money, we're investing into one of those opportunities. I mentioned we get 10 to 12 opportunities a year. So, we raise money every month, as we have investors come in, and there's always something solid available that we can invest in within 30 to 45 days. So we have very little cash sitting on hand.
Yeah.
And then separately, last year, we opened up a separate platform that allows investors to choose from individual deals. So we'll put those 10 to 12 deals a year up and give investors a window to invest directly into that property. And it functions like a somewhat of a crowdfunding platform or brokerage account where people can invest still through one fund, but the fund is customizable and you can choose exactly which asset to invest in. And right now we have a few different options on there. There's a multifamily apartment complex in Dallas that is that exact value add scenario I mentioned, where it's an 80s built product. Dallas is booming, and there's such a demand for that workforce middle class housing where if you take units that we call classic units that haven't been renovated in 10 or 15, 20 years and put new kitchen cabinets, new bathroom, new flooring, there's a really high demand for that tenant that needs to pay that $1,400-$1,500 rent, that'll pay for a quality unit that can't afford to pay $2,200 to $2,500 to live in the Colony or Frisco and the really high-end expensive parts of Dallas. We also have a private lending fund on there as well that just does short-term high interest rate bridge loans for real estate investors. So that's more of an open-ended fund, but pays double-digit returns, quarterly payouts. And we have a Dallas deal we're looking at right now. And we also, the most unique thing we've invested in is it's a marina that has an RV park component and 10 cap entry. So that means overall returns are mid-teens or better for that. And it's a niche asset class. And much like self-storage was 10 or 15 years ago, there's most of these RV parks and marinas are owned by mom and pops. And one of the examples they gave is they had a whiteboard with individual rectangular Post-it notes for each dock, and they were tracking who paid their rent by marking like a Roman numeral on the Post-it note per year. So
that's effective.
Yeah, and they had 15 family member cell phones on their plans. So they were running the business like a family business, not like a private equity fund. So there's so much room for efficiencies when you're buying a business off of someone who's didn't need to wring every dollar out of it because they owned it a long time and they're using it to kind of employ or support some family members and running it as like half a business, half a charity. So those are some of the things we're doing. I just before this call was on a call about a industrial building. We do love industrial. It's as there's more reshoring happening in the U.S. I think there's going to be more manufacturing jobs, more industrial. There's a lot of logistics, and just think about all the electricians, heating and air conditioning. They all need someplace. They don't need big offices, but they need a warehouse, storage, workshop, and then perhaps maybe a small little office for a couple desks or a couple garage bays. So record low vacancy in the light industrial. There's definitely a supply shortage in most markets for that. So it's an asset class we keep an eye on as well. But at least half of what we do is that cookie cutter multifamily value add. That's something that's a core, and I expect will remain a core of our business. Then we look for interesting asset classes for the other diversification.
So you have an anchor in value add multifamily, but it sounds like you're opportunistic for other asset classes. Am I summarizing that correctly?
Absolutely. And what we like about some of those other asset classes is the cash flow is generally a little higher. That industrial, it's might be 8% cash on cash day one. Whereas in multifamily, a lot of times, especially the first year while you're going through the value add component, sometimes there's only 3 to 5% cash flow the first year, and you need to kind of wait for your renovations to increase the rents to get your cash flow up towards that 8 to 10%.
Let's talk about the marina for a second, because that just sounds like a marina / RV park sounds like an absolutely bizarre. Like, I'm just talking from a visceral standpoint. So tell me about how that deal like came to you. I mean, it must have been, it was probably something you weren't searching for. So tell me about that story.
Yeah, so I went on an investor cruise last year. It was on a
Mhm.
Royal Caribbean boat, and there was about 150 investors, that were on the boat. There's 5,000 people on the ship, but we had a conference room during the sea days. There was events and presentations, and I spoke and talked a little bit about syndication investing.
Mhm.
One of the now someone who's a partner in the marina now, but at the time still had her broker dealer license. So their first fund was actually represented by a broker dealer, and that's not a requirement by any means, but when you're actually represented by a broker dealer, there's also a level of diligence that the broker dealer has to do to take you on as a client. So at least from
Yeah.
an initial elevator pitch for this, asset that I mean, RV parks were, something I'm somewhat familiar with,
Yeah.
especially it's a pretty hot asset class. But the marina side of it, I was a little apprehensive because I didn't really know anything about it. But that was the initial meeting. We got to spend a week on a cruise ship networking, and got back and then had a conference call with the the ownership team. I visited them in Dallas, and what was good about that deal too is they'd already bought the marinas. They were just finishing their raise, so they had already closed on them and were operating, but there was another less than $1 million left that they wanted to raise for capital improvements. So I got to see the numbers ahead of time too. So that made it a lot easier to dip our toe into that investment, that we already saw positive progress in in their net operating income just from the time they took over. And it made it a lot easier. And look, it's not that much of a departure from anything else. You've got recurring revenue. This one was in Tennessee, by the way, so you don't have to worry about the water freezing. But you've got recurring revenue, and you have a value add component. Whatever we look at, we look for where is the value add. And in this scenario, back in the 80s, more people had sailboats. Now everyone's got power boats. They want a wakeboard. They want a tube. So there was a waiting list for covered docks. And this marina had some covered docks with a waiting list, but there's other docks that were set up for sailboats that don't have covers on them that could be monetized. So business plan day one is cover the docks. This way people, they go out tubing for an hour, then they want to sit in the shade, drink a couple Miller Lights, maybe watch the game, and and that's unlocking significant amount of extra revenue just from that. Additionally, there's houseboats on the property. So they're actually doing Airbnb and VRBO for houseboats.
Wow.
That don't move. And so it was a bit of a departure, but ultimately it's still a real estate play. And, by the time we dove in, it really wasn't that much different than any other real estate deal that we've done in the past.
Let's talk about RV parks and marinas from a financing perspective, because I'm not familiar. I'm familiar with financing mobile home parks, aka manufactured housing communities, apartments, industrial, retail, all that stuff. With there being maybe shorter term. I mean, there may be yearly contracts for RVs. I'm not sure, but like, how does that, like, the seasonality and all that stuff play into actual like bank financing and that type of stuff?
Yeah, I mean, it's certainly a niche product, and I think a greater chunk of the financing is going to be that community regional bank that's familiar with the area. I do believe that one of the marinas though has a Fannie Mae loan, so it's not out of the question. And then depending on the location, there's certain scenarios I think you might even be able to do a USDA type of loan. So there is potential for some government loans, but it's definitely going to lean more towards community regional banks, and not a product. Multifamily has both Fannie, Freddie, HUD, and a ton of Wall Street backed or non-bank lenders that securitize into CMBS. This is definitely more of a regional product. But with it, and then to your question on the recurring, I mean, it's a very, very sticky asset. People don't want to move their boats for unless there's like a major life event. It's way stickier than multifamily. So from a stability of the P&L and balance sheet for the banks to get comfortable, it's pretty stable. This one marina also does have like a restaurant, so there's a little bit of business income, food and beverage, but a fair amount of the revenue is recurring. And then similar, the Airbnb houseboat component, that's a little more seasonal, but they've got a number of years of track record, and certainly as we move forward towards a long-term refinance, I expect those numbers to increase. Mm-hmm. And overall, I feel like it falls into the baby boomer, the average owner of a boat's in their 50s or closer to retirement too. And I think as boomers, as more boomers retire, there's likely to be more boat ownership. And it's the economy can be cyclical, but in a down economy, more people may do closer to a staycation or drive an hour or two to a lake instead of flying to Europe. So I think it's pretty recession resistant as well. And generally those that own boats are a little more affluent as well. So whereas at least the last year, the Class C, the lowest end of the apartments seem to be squeezed the most because of inflation. Yeah. So I feel like this is a protective play because somebody who already owns a boat likely isn't going to miss their payment because a gallon of milk went up 50 cents or eggs went up.
Yeah, no, 100%. So I want to go back because I did have a question about this unique scenario that you were doing one format in terms of a fund. Like, what was the impetus or what was the catalyst for you creating this second thing, which was a unique option of people being able to customize and that sort of thing with what they were investing in? Like, was there like a marketplace need you were seeing out there? Or was it you were hearing from investors that like, hey, I like these deals in this, but I don't like this in this fund? Like, tell me about that.
Yeah, we definitely took feedback from investors, and I had a pretty good idea that there was money that would have invested if it was in the individual deal that was not investing because they didn't, they really didn't like funds and they wanted the control. And it comes down to, as I've looked at, are the investors we work with, we really have two, I'll use a little marketing term here, two avatars, if you will, of the type of investors. One is just, moving money out of the stock market, wants to do some real estate, but doesn't want to do it themselves. The doctors, the executive, the tech person, hiring professional and business owner that just wants an allocation, wants to do something outside the stock market. And, they're a much better fit for the diversified fund. It gives them the diversification across multiple assets, multiple partners, multiple sponsors. The other group we've done a lot with is the tired landlord. They already own some properties. They know the business. They're already making a lot of money in rents, so they have passive income. And especially the older ones that have owned properties a long time, they might have depreciated them all the way. And so they're actually paying tax on their rental income. They know real estate. They want to look at every deal. They want the action. They want to see it. They want to understand it. They still want the kind of the excitement of looking at a deal, but they know how much work it is in the back end, and they actually are making a conscious decision to start investing more passively, and the tax benefits are great for them as well. So that type of group has been a group that loves the platform, loves to invest in the individual deals. And, we do a deep dive. They understand the asset, and, I think they generally, they know if something's going up on there, it's because I like it already and I'm likely investing. So, it's a convenient way for them to, look at individual deals and decide whether they're in or not. And also just manage their portfolio. Sometimes towards the end of the year, there's a big need for that depreciation. So sometimes, our deals in the fourth quarter almost always have the highest amount of cost seg, where for every dollar you invest, you might get 70, 80, 90% loss on paper for your taxes. So, it gives the flexibility to really focus on those deals. Some people want more cash flow and less upside just because they're, working towards retirement, need cash flow. Others, pure growth. They have enough cash flow and they just want the best overall return and the highest overall equity multiple on their invested dollar.
I think that's smart. So going into, because I just have some commentary here too. It's like, this is no offense. Like, I would never invest in a marina or RV park. I don't understand the business. Like, I don't want to be any like, but there's a value add apartment community in Dallas. I like that market. It has long-term growth potential. I'm an investor that's not motivated by cash flow right now, but by equity multiple, like a long-term equity multiple. So I think that was smart to offer that customization in there. Now, getting down to like the granular detail here. So it's like, let's say you have, your fund is going to be investing in the Dallas deal, and then you're going to have these other investors that are going to be on a one-off into this deal. How does it sort of like get like, I don't know, broken up mechanically in terms of those two things? Like, are they just have different membership interest in the LLC that owns the building, or what?
Correct. So each of those funds it's two completely separate entities that are just investing side by side each other. So there's no commingling of the two funds. The fund doesn't invest through the other fund. We're both facing the property level entity or the fund. If it's like the marinas has a few different marinas in it. So yeah, we're both co-investing directly in the deal side by side with no, really the only relationship really is both vehicles are getting better terms. And that's just part of just us negotiating better terms because we're a partner in the deal. Yeah. And that's really it's just sort of the benefit of investing at scale, and the fact that I have, I may have a part of the partnership. I may be on, kind of the equivalent of on the board or on a committee or have more insight into what's going on just because of my relationship.
Yeah, absolutely. So we have a workshop coming up in April. I'm really excited for you to come into Rochester, and also to hear about, for you to share your background and all of the gory details that were involved from, because it sounds like, you've had and this is leading up to my next question, you've had the history of like getting your butt kicked and then having to adapting pretty well to your environment in adverse conditions. Was this something that was like you were born with, or was this something like you just had to do it out of survival? Like, just kind of tell me about your story about how you've been able to build this skill set of adaptability throughout your career.
Yeah, I mean, I was definitely either born or very early on, knew I had this drive. I had great parents who kind of told me I could do anything I set my mind to, but I watched them struggle. I think what really built in that drive is just like watching them stress over money at a young age and wanting to, to make it and not have that stress myself. So, I mean, that part was built in, and I think got me, that initial drive, and is what caused me to, why I went into computers. I liked computers, but I remember seeing some magazine of like, highest paying majors, computer science, 50 something thousand back in the 90s, which, but then, going through the adversity, I mean, I had a tough year or two, like a lot of people did in 07, 08, everything. And Rochester wasn't nearly as bad as say, Phoenix or Vegas, but, the financing had froze. So it was really, I was still young and undercapitalized, and it was really, the whole business got turned upside down, and had to, figure out at about a year where I just didn't know what I was going to do. Just, persevere in Rochester and just do the best I could. And, it happened to, that this new opportunity popped up, but it's just always moving forward, always just continuing to, network, look for opportunities, and, certainly not being overly optimistic that you make bad decisions, but just know that there's in every cycle, there's a ton of opportunities. So that was, I think the early perspective, and then just sort of learning through, having some success from the downturns. And now, I mean, when the COVID happened, so I'm not going to say I didn't have some anxiety, especially that we weren't going into some zombie apocalypse, but when the stock market was down 30%, it's like, okay, I've seen this before. I didn't panic sell. I actually bought some stuff at the bottom. I don't do a lot with the stock market, but just the money I had, I was not panicking. And then real estate wise, I knew, even if things get bad, there's going to be opportunities to buy. And, having aligned myself over the years also with, some well-capitalized private equity funds and other groups that, I knew one way or another, there's going to be a way to capitalize on, on the deal flow, just by being prepared and having, just building relationships, trying to add value however I can, regardless, which is, why I do what I do right now. And I love educating. I love, one of the things we'll talk about at the workshop is, how I created my fund and how someone else could create a fund. I don't look at that as I'm creating new competition. I have that abundance mentality where, a rising tide raises all ships, and, maybe someone in that group starts their own fund and we co-invest together on a deal and we both get better terms because of it.
I love that. Yeah, no, I'm really excited for it. For those of you guys who are listening in or actually watching this right now, we have a workshop that's on Saturday, April 13th. That is in downtown Rochester. Jack is coming back into the Rock, and it is at 9 o'clock in the morning. It's a half day workshop. We end at 12. Weather pending, we'll be able to walk over to Dinosaur Barbecue afterwards and maybe have a couple of Miller Lights or Jenny Lights. Yeah, let's call it Jenny Lights because we want to be.
Oh, that's right. Oh, I missed that Wango Tango hot sauce. I haven't had that in years.
Absolutely. So, yeah, so I mean, we're going to go into Jack's origin story. We're going to go into the specific mechanics of like how to start a fund, mechanics around like scripts and talk tracks around how to build your OPM prowess as a real estate investor. And also, thirdly, I'm excited to actually dive into some like case studies that Jack is going to have prepared for historic deals he's done in terms of those slide decks or pitch decks on there. That is going to, you'll be able to walk away with a lot of actionable type of stuff. And it's going to be valuable to those people, like not only people that want to position themselves to raise capital, but also those people that are the tired landlords that want to learn how to vet sponsors, everything happens behind the curtains from a mechanical standpoint, because most investors, all we know is S&P 500 index funds or Charles Schwab mutual fund or Fidelity low price stock index, that sort of thing. This is a completely different industry. So if you're looking to get educated on investing in an asset class where you can actually take advantage of market inefficiency, which is where a lot of money is actually made in real estate, you got to be educated as an investor, and this is what you're going to learn at the workshop as well. If you're interested in how to learn how to passively invest, you're going to get a lot out of this workshop as well. The early bird rate of $89 expires on Sunday, so don't pay stupid tax. If you're looking at getting this workshop, definitely go in and get that before Sunday. It goes up to $129. And then we have what is it? Yeah, and then we're going to be. This thing, we're actually getting close to selling this thing out in terms of capacity. So definitely jump in and take advantage of that. And you'll be also supporting a nonprofit, which is Freedom First Real Estate Investors Association, where our mission is to help empower those to build community and fellowship, and also to education and real estate investing, with the idea of building multi-generational wealth for people and their families. So we're almost to the top of the hour, Jack. What words of advice do you have, or anything out that you're seeing out there, anything in terms of closing remarks that you'd like to put before we wrap it up?
I'll add one thing on the tired landlord thing, is that tax side of it, which I mentioned briefly, but there's also some very custom things that can be done with 1031 exchanges. So in addition to vetting sponsors, if you've got a portfolio of properties, you could actually 1031 into a passive investment in many cases and do that completely tax deferred. So that's something I'll cover a bit. It can be a little complex, but at least I'll cover enough that you can learn and have a more detailed conversation if you're in that spot where you want to maybe try to sell off some properties and you're afraid of the tax hits. Just overall, I think you said it great. We're going to have a ton of content available, ton of value we're going to drop at the event. The key is just to take action. I know there's also an event Thursday before, right? The larger real estate club. So if you want to preview, you can come to Thursday night and just go to the general real estate investor meeting. And that's the first step of really taking control of your life, is to just get some level of education, meet other investors, meet the industry experts, but also just meet other investors, some of who are beginners as well, some of whom are a year or two ahead of you. And I've always found that person that's a year or two ahead, but's not so far ahead, is always a great person to learn from, and just give you the perspective that, none of this is rocket science, and it's not that heavy of a lift if you just take a few steps at a time. So I'd encourage everyone to come out. I'm really excited to make my return to Rochester and to meet everybody.
Absolutely, yeah. And also, Jack, you brought up a good point too, is that we do also have Jack's gonna be coming in on Thursday, April 11th for a preview, which can be like a very, very like a mini high level. If you are available for the Saturday workshop, get your tickets now. If you just can't make it to the Saturday workshop, then Thursday will be a good segue into getting some Q&A, learning high level about the fund space, the private placement space in terms of real estate, and also be able to meet a lot of the people that are active in in our community as well. So that being said, Cassie is actually gonna stop recording at 3 o'clock, but I actually never have asked this question, Jack. What do you do for fun?
So I love to travel, and I was fortunate during my time in private equity Wall Street. Our servicing companies were on the West Coast, so we was doing a lot of West Coast travel between going to our service company sponsors. So I built up a ton of miles, and I'm an avid follower of the Point Sky and the boarding area blog. So I know almost every trick in the book for flying business and first class. And my goal is to fly like every major product and really to see the world. So I actually ended up doing an international MBA as well, and I flew to Hong Kong probably 10 times. And, I flew Cathay Pacific first class. I flew Asiana first class. And it really, allows me to see the world. And it makes the flying part of the fun. And I've taken these 12, 14, 16-hour trips that normally I would have dreaded or probably not taken the trip. So, fortunately now, I have a lot of flexibility. I mean, most of our work is really on the initial vetting. And once the deals happen, if I want to take a few weeks off, I could certainly do that. I know I'm not getting a call about a toilet overflowing. So travel is the major hobby. I will say I played pickleball for the first time yesterday, and I feel like I know I'm officially getting old, but B, it's actually a lot of fun, and I'm probably got another hobby because I can see how it's addicting.
Yeah. What's on the map next for you from a travel perspective? Or like, where have you let's not talk about what you have on the calendar. Let's talk about what you want to have on the calendar that you've never done before.
Yeah. So got to do the South Africa trip, both, Cape Town for food and wine, and, head up to, Kruger, one of, the national parks, and do the safari. That's definitely one of the more adventurous trips. And, from beach wise, I mean, the Maldives, just from a purely checking it off the list of just doing kind of that epic, I've just read about it too many times. And then on a more, it's very easy for me to get to Argentina I have these global upgrade certificates where I could basically buy economy and fly business class. So I've been to Buenos Aires twice. I want to do Patagonia and really see. I mean, Argentina is dirt cheap right now because there's, they've, unfortunately for them, have had a currency crisis. So you could be in Buenos Aires and you have, a 2-pound steak and a bottle of wine for $12 US. It's a stack of Argentine pesos this big. It's a great country. It feels almost like it feels more like you're in Europe. It's just a very, I think in the 20s and 30s, it was one of the wealthiest countries in the world. And unfortunately, they've had, not to get too much into politics on this, but they've had, I think, made some bad political decisions for the last 50 years. And, it's unfortunate, but they just got a new guy in who's really much more, fiscal responsibility, and we'll see what happens there. Hopefully things improve, but it's an amazing country, amazing people. And, that's something, and I could basically work from there. It's 1 hour ahead of the East Coast. So,
sweet.
It's actually a great place to do more of the Tim Ferriss kind of, digital nomad type of thing where I could function, I could work, internet's fast, and, could see the country without really being truly on vacation.
Yeah. That was my one thing is my wife and I love Italy a lot. We're actually going back there, I think, for a 5th time, but it's going to be for a month in 2025, in May to June 2025. But we're going with a mission this time, and it is to get dual citizenship status for my wife, whose grandmother was an Italian citizen. So it's just something that we feel is like a important multi-generational asset to have. And so we're going to go there not just to travel this time. We're going to go there to actually perform a task to do that. And the one thing that's brutal about that is the time difference. There's a small sliver of time that you can really actually connect with people that are on EST, for instance, whereas most of my business is. And I'm not an email or a text message guy. I'm like a phone call person or Zoom call thing, because there's a lot more information that can get uploaded and downloaded through a phone call or just a conversation rather than email and that sort of thing. So I'm looking forward to that as well.
Awesome. Well, hopefully over the next year, you get a little bit more passive, and you know, you've built some great processes for your business already. So hopefully you can get that next deal nailed down, have it set, so you can go on vacation in peace.
All right, sounds good. All right, well, Cassie, I don't know if you're listening or not, but we can hit the stop record here, and then oh yeah, and then also if you're listening here, we'll have the link to the oh thanks thanks Cassie, and then we'll have the link in the show notes to the workshop, so you can get your tickets there. Thank you so much, and peace. Thanks for coming on the show, Jack.